There are two completely different ways your data can travel across the internet. One guarantees that every single piece arrives safely in the right order with nothing missing. The other fires data off as fast as possible and genuinely doesn't care if some of it never arrives. And here's the part that surprises most people. Your trading app uses both of them at the same time on purpose. Let's start with TCP, Transmission Control Protocol. The way TCP works is methodical by design. When your device sends data using TCP, it breaks that data into numbered chunks called packets. Each packet goes out individually, and the receiving server sends back a small confirmation, called an acknowledgement, for every packet that arrives. If a packet goes missing or arrives corrupted, the server notices the gap in the sequence and requests that specific packet again. Nothing gets handed to the application until the full message is confirmed complete and in order. Think of it like a careful courier service. Every package is numbered. Every delivery requires a signature. If the courier can't confirm a package was received, they go back and deliver it again. Nothing slips through the cracks. But that back and forth confirmation process takes time. There's overhead built into the system by design, because the system's priority is accuracy over raw speed. This is exactly what you want when the data in question is an order to buy or sell a financial instrument. You cannot afford to lose half of a trade message. You cannot afford to have it arrive out of order. You absolutely cannot afford a duplicate. Imagine a buy order being delivered twice because a packet was resent unnecessarily. TCP's overhead is worth every millisecond when the stakes are that high. Now let's look at UDP, User Datagram Protocol. UDP takes the opposite philosophy entirely. Instead of breaking data into numbered packets and waiting for confirmations, UDP just fires packets out as fast as possible with no tracking, no acknowledgement, and no retry mechanism. If a packet gets lost along the way, UDP doesn't know and doesn't care. The next packet is already gone. That sounds reckless. And for certain types of data, it would be. But for other types, it's exactly the right call. Think about a live price feed delivering thousands of price updates per second. If one tick, one single price update out of thousands, gets lost in transit, does it matter? Not really. By the time you'd even notice it's missing, 5 more updates have already arrived with the current price. Going back to retrieve a stale price tick from half a second ago would actually make your data less accurate, not more. This is the key insight for data where speed matters more than completeness, and where missing one piece doesn't meaningfully damage the whole picture. UDP's lack of overhead is a feature, not a flaw. You get lower latency, higher throughput, and none of the back-and-forth confirmation delay that TCP requires. So where does each one actually show up in a real trading system? TCP handles anything where losing or corrupting data would cause a real problem. Order placement, the message telling your broker to buy or sell, runs on TCP. Order cancellations run on TCP. Account authentication runs on TCP. Any instruction that triggers an action with financial consequences uses TCP because the cost of a dropped or duplicated message is too high to accept. UDP or UDP-style approaches handle the high-volume, time-sensitive data streams where losing an occasional packet is tolerable and speed is everything. Live market data feeds, price tickers, real-time order book updates. These are the kinds of data streams where firms often use UDP-based multicast delivery, pushing the same price update out to thousands of subscribers simultaneously with minimal overhead. Some systems use a hybrid approach, TCP for the control channel, the instructions and confirmations, and UDP for the data channel, the continuous stream of market information. 2 parallel connections, each optimized for its specific job. Here's a real-world experience that makes this concrete. You've probably noticed that your order confirmation, the notification that your trade actually went through, always eventually arrives, even on a shaky connection. It might take a moment longer than usual, but it gets there. That's TCP doing its job. The system keeps retrying until it has confirmation that your order was received and processed. But you've probably also noticed that your live price ticker occasionally skips a number during a fast market. The price jumps from one level to another without showing the values in between. That's not a bug. That's UDP working exactly as intended. A packet or two got dropped in the chaos of a fast-moving market data stream, and the system moved on without them because the next update was already more relevant. Once you know this, a lot of previously confusing trading platform behavior starts to make sense. The order side of your platform and the market data side of your platform are operating under completely different rules by design. Here's the practical takeaway for anyone evaluating a broker or a data feed provider. When you're looking at a broker's technical documentation or asking their support team questions, it's worth knowing which protocol they use for which function. A broker that uses TCP for order execution is table stakes, and that's what you'd expect and should require. But how they handle market data delivery is more revealing. A broker delivering live price data over a well-engineered UDP multicast feed is making a deliberate, sophisticated engineering decision optimized for speed and scale. A broker still polling REST endpoints for live prices, which we covered in Day 7, is essentially reinventing a slower wheel. The protocol choice tells you something real about the engineering quality underneath the surface. You don't need to be a network engineer to ask the question. How do you deliver live market data? Is a perfectly reasonable thing to ask a broker's technical support team. The answer tells you more about their infrastructure than almost any other single question. Let's recap. TCP is the careful courier. Numbered packets, confirmed delivery, retries on failure. Perfect for anything where losing or duplicating data has real consequences, like order placement. UDP is the rapid paper airplane. Fast, lightweight, no confirmations, no retries. Perfect for high-volume data streams where speed matters more than completeness, like live price feeds. Trading systems use both, running in parallel, each optimized for its specific job. Tomorrow we go one layer up the stack, to the doorway that every trading app uses to actually talk to a broker's system. What is a broker API, really, and why should every trader understand it, even if they never write a line of code? Subscribe so you don't miss it.